Hi, everybody. Welcome back to Aux Talks. It's Friday, February 16th, 2024. Wrapping up what I hope has been a productive work week for each and every one of you. A lot to cover today. Before I get into it, as always, I want to thank you for watching these videos. I want to thank you for please hitting the thumbs up button and clicking on the bell notification as well. Most importantly, please share the videos. Repost them, share them with your family, friends, colleagues, and coworkers so we can continue to do our best, do our part to wake people up. Can we come with all the solutions? No, but we can definitely come with a level of knowledge and preparedness that hopefully others that are not as like-minded or as prepared as we are can learn from this and take the steps necessary now before it's too late to prepare themselves and their family for this economic train wreck, which is accelerating. I took on a new case today. I want to share just briefly with you. I can't divulge, obviously, any confidential information, but it is a real property dispute. On many videos ago, even maybe a couple months ago, I addressed a situation where if you're buying a piece of real property and the seller is carrying the financing, meaning you're financing a portion of the purchase price, whether it's commercial, residential, whatever, through the seller, you need to exercise caution. Another case on my desk today where it's a botched seller carryback transaction. This time, my client is the buyer. My client several years ago purchased this property from a seller. The seller was a holding company, an LLC. While the client was paying off the note, the LLC, the members and the partners of the LLC had a falling out. There was litigation, and basically there was a disbanding of the company. So this was all happening while the buyer, my client, was faithfully making these payments to pay down the debt. As you can imagine, the debt gets satisfied in full. Request is made for the deed to be transferred and a reconveyance, and the surviving partner of the LLC is refusing to cooperate. So now we have a situation where title's not in my client's name. He has paid off the debt. He's completed all of his obligations under the contract, and now he has to go and potentially file a lawsuit against the seller entity and the individual members of that company to quiet title, to force the transfer of the title so he gets what he bargained for. In any event, it can become a real nightmare because now he's going to have to start incurring legal fees, time with me, potential court costs. And so just wherever you're at, whatever jurisdiction, whatever state, I'm not giving you legal advice. But if you find yourself in a situation where you are buying property and the seller is acting as the bank and carrying financing, so many things that are totally out of your control can go wrong on the other side. In this case, the LLC partnership, the seller partners had a falling out, and it's impacted this whole transaction. So just another thing to keep in mind. I'll continue to bring these little stories to you as they come across my desk. So hopefully you can learn and at least become more diligent between you and your legal counsel to make sure you're doing due diligence and not putting yourself in precarious situations when you are acquiring real property. So let me talk about the stories that have unfolded today. Interesting, the markets kind of sold off at the end of the day. Dow was down about 100.5, S&P, the NASDAQ was down over 100 points. I'm surprised it didn't sell off more. We'll address the producer price index numbers that came out this morning, which shows inflation continues to run hot. And I'm surprised the market did not sell off more. Another interesting dynamic that I saw today was the yield on the 10-year bond was up about 5 or 6 basis points. And the dollar, the index was up just very slightly, the US dollar index. Usually those two things are a recipe for gold to fall. Right now, as I'm doing this video, gold's up about $8 per ounce in spot price. And it's interesting that gold has, well, maybe gold is recoupling with the rise of inflation? I don't know. They've been divergent for a while now, meaning when we see the 10-year bond rise and the dollar rise, normally that's been bad for gold. So again, for all of you that have considered diversifying assets, have considered precious metals as a form of savings, as a form of wealth preservation, you might want to look into it more. There's some interesting dynamics going on in the markets. Am I predicting pricing? No, I don't even watch. I watch it to report on it, but I check it maybe once a day. If it goes down $20, $30, $40 an ounce, if silver drops $1, I don't care. This is a medium to long-term horizon for me. It's not a get-rich-quick scheme. So gold and silver may become your friends here pretty quickly. Look into it if you haven't. So layoffs continue. Nike is cutting, this is news today out of CNBC, Nike is cutting 2% of its current workforce, or more than 1,500 jobs, as part of a, once again, broader restructuring, the company said late Thursday. It says the Oregon-based sneaker giant said it wants to better the use of its capital to invest in growth areas. This is how we will reignite our growth, according to CEO John Donahue in a memo obtained by CNBC. So this is a painful reality and not one that I take lightly, he said. Nike said the layoffs will take place in 2 phases. The company will start the first round this week and finish the second by the end of the fiscal fourth quarter, which is typically at the end of May for that company. It says the cuts come as consumers become more cautious in their spending and the retail industry braces for a demand slowdown for discretionary items such as shoes, which is Nike's bread and butter. I didn't realize shoes were discretionary items, but maybe $500 sneakers are. The article goes on to say, in December, Nike unveiled a broad restructuring plan to cut costs by $2 billion over the next 3 years. It lowered its sales outlook as it prepared for lower demand and wholesale orders, soft sales online, and a marketplace that relies more on promotions. Shortly before the restructuring was announced, the Oregonian reported that Nike had been quietly laying off employees over the past several weeks and had signaled that it was planning for a broader restructuring. The division saw a series of cuts, including recruitment, sourcing, brand, engineering, human resources, and innovation. It's not clear how many jobs in total Nike has cut in December. So more layoffs in other sectors of this economy, other types of business. It's not confined just to tech, guys. So again, if you work for somebody, if you rely on a 9-to-5 job and a paycheck, please consider starting your own business, form a corporation, maybe consider forming an LLC, start a side hustle. Do it the right way. Don't come in and take on a bunch of debt. Start slow, but try to make yourself as independent as possible relative to generating your own income stream. This is going to continue, in my opinion, to get worse. I'll keep bringing these stories to you as I see them announced. Talk about mortgage rates. This just came out of CNBC a couple hours ago. Today, no surprise, because the PPI numbers are hot. The CPI numbers were larger than expected. Mortgage rates have spiked again. This says mortgage rates shot higher Friday after a monthly government report on wholesale prices showed inflation is still persistent and hotter than most analysts had expected. It's always hotter than most, or unexpected, or worse than they expected. The average rate on the 30-year fixed mortgage jumped to 7.14%, according to Mortgage News Daily. This is the highest level in 2 months. So for all those realtor cheerleaders out there telling you to get into the housing market, get in now, it's because you can refinance as the rates start to come back down. It's going in the opposite direction. Mortgage rates hit their high in October, but then fell sharply over the next 2 months, leveling out at 6.6% in December. It says now they've climbed back over 7% last Friday after another government report on consumer prices came out higher than expected. So when the CPI report came out last week, The 30-year mortgage spiked to 7%, and now today it's at 7.14%, as we see the PPI numbers also hotter than expected. It says there are two ways, this article says, quote, there are two ways to look at recent rate trends in light of the data-driven spikes over the past 2 weeks, said Matthew Graham, Chief Operating Officer at Mortgage Daily. Quote, on the one hand, we can take solace in the fact the rates are still almost 1% lower than they were in October. On the other hand, the optimism for lower rates in 2024 has abruptly given way to skepticism. And that is the point. If you're drinking this Kool-Aid thinking that the rates are going to come back down, so far, none of the data that's come out in the last couple of weeks that the Fed's going to look at and rely on in deciding when and even if it's going to cut interest rates is going in the opposite direction. It's not feeding or supporting the narrative that you're going to see a bunch of rate cuts this year. So keep that in mind when you take on debt. When you take on new credit cards, these rates are going higher, and they may continue to go higher. They probably will. Let's talk about again, this feeds into the housing market and mortgages. Housing starts collapsed in January, biggest month-over-month decline since the pandemic lockdowns. This is out of the Zero Hedge this morning. After single-family home starts plunged in December, analysts did not expect much of a bounce back in January as rates remain high, and we know higher as of today, and some regions were affected by weather. Analysts were, once again, way off. It says housing starts, they use the word puked, or declined 14.8% month over month in January. What they expected was unchanged. So the economists, the experts expected housing starts to be flat, unchanged from last month, and actually it dropped 14.8%. I mean, that's a massive miss in expectations versus reality. It says, but December's 4.3% month-over-month decline was revised up to 3.3% month-over-month rise. Building permits also tumbled down 1.5% month-over-month versus 1.3% expected, and are down from the 1.8% month-over-month in December. It says this pushed the housing starts, seasonally adjusted numbers, near post-pandemic lows. So again, we're having to go back in history to pandemic lows. How many days I come out here and say, look, we're having to compare numbers and data from 2008, 2009, 2010 during the great financial crisis. We are back in those territories, guys. So please pay attention to this. It says, do not blame the weather. It's January. We know there are weather issues, and that should be more than priced in on a seasonally adjusted basis. Multifamily permits cratered also to their lowest since, when do you think? October 2020, when there was a forced shutdown of the entire country. Permits for one-family homes says edged higher after rising consistently through 2023. And multifamily starts were even worse, plunging from 489,000 seasonally adjusted to 314,000, the lowest since May of 2020, again, when the economy was closed. Number of single-family homes completed plunged to the lowest level since May of 2020 as well. And this article concludes by saying they built it, but no one came, which I think is funny. The inventory of new homes for sale remains elevated and suggests builders may be cautious about beginning new projects. So, I mean, the builders are looking at these rates too. They can only do so much to incentivize new buyers, to buy down rates, to offer incentives. And so, when is this thing going to completely implode? We don't know. But it certainly is accelerating, and it's going in that direction quickly. Last one I'll share with you, and I alluded to it a couple minutes ago, was the Producer Price Index report came out this morning, and the producer prices surged in January as service costs soared. So after the hotter than expected CPI, which has been shrugged off entirely by the stock market, again, there was a big sell-off initially on that, and then all week the market's for the most part been rising. Today it pulled back a bit. It says producer prices were expected to rebound very modestly month over month, but continue to slow on a year-over-year basis in January. Instead, once again, like CPI, it reaccelerated with headline rising 0.3% month over month versus 0.1% expected. So they missed it by 300% on their expectations, which left PPI up 0.9% year over year, down from December, but hotter than the 0.6% expected. So again, they were off by 35% in their estimates. The picture was even worse under the hood, with PPI accepting food and energy up 0.5% month over month, and plus 0.2 prior, and plus 0.1 versus, let me back up too fast. 0.5% month over month versus 0.2% prior, and 0.1% expected. And excluding food, energy, and trade, up 0.6% month over month versus up plus 0.1%. I know these stats, may just start to fill your head, but I share them because the misses are so substantial. The divergence and the decline in these metrics is so substantial on some of these that it's important, I think, for you to hear that. It says, in fact, core PPI reached a new record high, now up 17.4% since the current administration was elected and put in office. Not going to go down that rabbit hole right now, but we've seen a 17.4% increase in PPI, core PPI, since the beginning of the last administration. Services PPI soared month over month. So you get the point. We have inflation going in the wrong direction. So for all of us that have to put food on the table, have to buy things and everyday needs for a family, it's looking dire. This is definitely going to feed into the Fed's narrative, and we're going to have to watch and see what happens. Again, I appreciate you staying tuned. I know some of the statistics get, kind of numbing after a while, but I'll continue to share this stuff with you as I see it unfolding and what I believe is important. I'll be leaving here in a little while. I have a call with some clients in about an hour, and I'll be going to get a workout in. Please get your steps and your cardio workout in today. Keep moving, whatever it is. Even if it's walking around your office or in front of your house, in your neighborhood, or around your office building, whatever you can do in your given circumstance. You don't need a fancy gym membership to take this stuff seriously and get in shape. What you need is the mindset and the consistency to do it. Watch the diet. Diet is more important actually than the exercise. So you need to have both those things in combination, working together. If you have any intention of actually making progress, whether it's losing weight, whether it's reducing your body fat mass, whatever it is, it has to be both. So I hope all of you have a great end of the work week. I should be able to put something up tomorrow and throughout the weekend. With that being said, I'll see all of you tomorrow or throughout the weekend. Bye.